Good evening, everyone, and welcome to our November webinar. We're going to get started just in about 20 seconds. Just want to leave a couple seconds here for people to file in. All right, so let's get started. So believe it or not, we are already at almost the end of November. And this is our next to last topic for 2024. So for those of you who have joined us each month, we thank you. We hope you found this session informational and brought value to you. So tonight's topic is going to be the impact of the election on the financial landscape. And obviously, the reason that we picked this topic for November is because it's very timely, right? A lot happened in this past month. So before we get into that, we want to just do the normal housekeeping items, right? So the webinar is being recorded. So for those of you who aren't able to catch us live right now, you can watch this back. For those that are live with us, you can use either the chat feature or the Q&A feature in your toolbar there to answer any question, to ask any questions, and then we will answer them throughout the program. We will take questions as they come in, and if we don't get to them, we will definitely get back to them at the end. So back to tonight's topic, the impact of the election on the financial landscape. So tonight we have a very distinguished speaker joining us, Amy Bryant, and Amy is a director of the advanced markets team within Penn Mutual. So Mickey and I actually got to hear Amy speak on this topic. I think it was back either in August or September. So before we really knew what was shaking out, and she was giving us some feedback from what we're hearing on Capitol Hill and kind of what the rumblings are of if how the election turns out, what that impact will have. So we thought it would be a perfect opportunity for her to not just educate us as the advisors, but to be able to bring her to our client base and give you guys some understanding. So I want to start it off that this is not a political type of webinar tonight. We're not going to be talking about either side or giving opinions. What we're going to talk about is what we believe will happen based on what the makeup is currently, or kind of what we know now to be true. Okay, so no opinions really in here from any political powers. Yeah. So first, let me introduce Amy. As I said, she is Director of Advanced Sales at Penn Mutual. She has been helping financial professionals like ourselves in the ultra high net worth marketplace for the last 26 years. She is a JD and a CLU, so she is an attorney, obviously, and she really specializes in estate planning with business owners, which has their own complex needs, obviously, especially you know that if you're a business owner, different compensation strategies and charitable solutions, which a lot of those things tie into taxes, and taxes going to be one of the big topics we talk about tonight. So Amy lives in the wonderful but cold state of Minnesota, which is where she is joining us from tonight. And it's already chilly there, much different than here in South Florida. And then you also see on the screen Mr. Jay Perlman. Jay also is a director with Advanced Sales at Penn Mutual. Jay's tonight going to be helping answer any questions that pop up in the chat or jump on screen if he needs to add some expertise as well. So with that, let's get started. I'm going to take that off the screen there. And Amy, I think it's important to kind of set the stage for tonight, okay? So before this month, right, there's been a lot of uncertainty really over the last couple years about some legislation that was set to change at the end of 2025 and go into effect at the beginning of 2026. I think for everyone listening, it would be good if you could summarize what those changes are supposed to be.
Absolutely, love to. And Michelle, thank you so much for doing this and for allowing us to be a part of this process. So the changes are really interesting because the changes come out of the Tax Cuts and Jobs Act of 2017, TCJA for short. Okay, so that TCJA was the Tax Reform Act of Donald Trump back when he was president back in 2017. They went into effect in 2018. And what's really interesting is because of the way it passed through Congress, certain provisions, certain rules of that Tax Reform Act have to sunset, which is, legal terminology for expire. They simply have to expire. They cannot stay on the books past the 10-year mark, which is January 1st of 2026. So it's interesting that Donald Trump is now going back into Oval Office because he is going to be able to do something a lot of presidents have not been able to do. Actually, I think only one other president, Grover, was able to come in and champion what they put in place in their first administration. So he's going to be able to come in, and we do believe that he will champion the TCJA, and these sunsetting rules, these expiring rules will probably continue on. And we're expecting him to get enough votes and enough support to have those continue. Real quick, I think it's important to help our audience understand the impact of those expiring rules on their plan. The first is estate planning. The TCJA gave us a huge exemption, which is an amount that your estate can hold before the IRS is going to expect taxes out of your estate. This year, it's 13.61 million per taxpayer. Next year, it's going to be 13.99 million because it's tied to inflation. The other one that we're watching is a business deduction for pass-throughs. So this is for your S Corps, your LLCs, partnerships. That deduction is called a 199A. And if you take the 199A and you qualify, you can get almost 20% deduction on the income that qualifies every single year. And that one has been a big, big deal for our business owners. And then for the individuals, it's a change in individual income taxes. Rates went up, they would go down, or excuse me, reverse. They went down, they would go up in 2026. And the amount that you make has to be much smaller to reach that top rate. So these were the things that as planners, we've been watching and talking about almost ad nauseum, quite frankly. And these are the things that we've been following, trying to get our clients in the best possible position to plan for that sunset. Yeah.
Yeah, that first one that you covered there, the estate planning, right? That has definitely been a huge topic for probably the last 2 years for a lot of clients that fall into that knew that they were, even under those larger exemptions, had an estate tax problem, right? So they wanted to do some planning, but there was a lot of people that I like to call kind of in the middle, right? That were going to be, if they revert back to that 6.5 million, right? Likely are going to have an estate tax problem, but if it stays where it is, wouldn't. So let's talk a little bit about that. Can you give any advice or kind of thought process for the people that maybe did some planning and move some assets out of their estate? And then if the law doesn't sunset and that exemption stays high, like what are the goods and the bads of that strategy now?
Oh, yeah. So real first point of business with that line of thought, if you have done planning, stay the course. You did good. You did your job. You did your planning. Stay the course for that. And continue to adjust it as we hope to see these exemption amounts increase over time. So that's point number one. The second point was articulated really well in a seminar I attended last week on this same topic. Some attorneys were talking about, what does this do? What does it mean to have these exemptions continue to climb? And they said that the middle market, your mid-America, dodged a bullet. That's the phrase they used. They dodged a bullet. And the reason for that is if this exemption had dropped back to the 6.5, the 7 million, it was going to hit the middle America folks, people people I work with every day, the ones that do not have the wherewithal to carve out $7 million to do tax planning. They just can't. So it was going to be a difficult planning discussion to have if the exemptions had dropped back. So that's really important. Finally, on this note, I think that this is actually a really good thing. I think that it's good that we will probably see these exemptions extended out and hopefully made permanent because it provides stability. I don't care if you have a $5 million estate or a $500 million estate. You need rules that aren't moving targets. And we're hoping that because Trump is in office, we will be able to get some stability, whether you like him or not.
So that was actually going to be kind of one of my follow-up questions to you was, do we see these changes like being able to happen, right? Do we see him being able to extend that? So you just kind of answered that, but I want to dig deeper in that. Is it an all or nothing? Like, is the whole bill get extended, or could it just be certain parts of that? Let's say the estate tax exemption gets extended, but then they take away the 199A. Is that possible?
It is possible. It's going to depend on how his administration addresses this. It could be one large bill that addresses all of this, or it might be piecemeal. I can tell you this. I'm part of a watchdog group, and we went to Capitol Hill in May. Was it May? I believe so. We sat down with all of our representatives, and there were 500 of us that went to Capitol Hill and sat down with our people in each of our states. And we talked to them about this sunset, the exemption, the 199A, the individual income tax. That 199A issue was on their list already. So even if Harris had gotten into office and not Trump, this is something that we were told when we went to Capitol Hill was on the radar for these representatives, these senators, and they believed that they would probably get something in the 11th hour. So Trump already has some support for that. With these other issues, the exemption, the corporate tax rates and whatnot, capital gains, all of that, we think that he has enough support that he could probably do it in one bill.
So going on the 199A, so you said that was probably going to make the cut either way. Does that have an impact on more of small business owners, mid business owners, big corporations? Who sees the real benefit from that?
That's more of your small business owner, because like a lot of tax rules, you can earn your way out of the benefits of that rule. And that's how this 199A is set up. If you make too much in revenue, then you don't get it. But if you make just that certain amount, and it would be considered, a middle of the road type of cash flow, then you do qualify and you can take it. And it's a 20% deduction against your profits, your income.
Any other, and we talked about the three big points, and those are the ones that, like you said, we've been talking about for the last several years, but we're in the industry. So that's what we're going to talk about. The consumers at home, they're not talking about those things. They're probably talking more about, the individual tax rates, because that's where what they understand more, and they probably feel more of the pressure. Is there anything else that's kind of embedded in that bill that would have an impact from a taxation or maybe effect on the markets, or any other that you could provide some guidance on?
Well, okay. So with the income tax, in the way I see it, that's more the wild card than anything else we're dealing with, because we do have some mixed messages on that particular point. Now, the last definitive thing that we heard from his administration was that he wanted to continue the top tax rate of 37%, as opposed to moving that up, which it would have done in 2026. So cap it out at the 37%, but we don't know really on what. 30%, 37% on 400,000 is much different than 37% on 700,000 in income. And so we're kind of in a holding pattern on that. And there's been some talk about, well, we're just going to do away with income tax entirely. I just don't
I
think
haven't
that's
heard that talk. Who's saying that?
possible. I know. Can you imagine? I'm like, well, at that point, yeah, I'll be a greeter at Walmart because, that's just not going to happen. But yeah, I don't think that that's a reasonable expectation. On the income tax issue, though, too, we've also heard the administration, the Trump administration, say that they're going to eliminate the SALT deduction, the cap on the SALT deduction. And let me explain what that is. So when you do your federal returns, you'll get a deduction for state and local taxes, SALT, state and local tax. And TCJA has a cap on that of 10,000. And we're going to take that cap away so that we no longer have the cap of 10,000 on that. So if you're in a state where you have really high state and local taxation, then you're no longer limited by that. So we think that that obviously is going to be a good thing, especially for our clients in states like California, New York. That's going to be a really good
Illinois.
thing.
Yeah.
Exactly. Yes. Yeah.
Okay. Yes. I was actually talking to a client today who's in Illinois, and his was like, Illinois is a very heavy state that's very heavy in taxes, were his words.
Uh-huh.
So,
Yeah.
all right. So that's good. So rather than that cap, so if he, for example, paid $20,000 in state and local taxes, he'd be able to have a $20,000 deduction now versus the 10 that it was capped at.
Exactly. Yes. Yes. So that's going to help quite a few of us. Yeah.
Absolutely. Yes. And we have a lot of clients, probably some listening tonight that are in New York. So they experience that
Ah,
same thing with heavy state and local taxes.
yeah. Exactly. So we'll get that back.
Very nice. All right. Any other points there from the TCJA that you think we should cover tonight for the audience?
You know, on TCJA, I think that again, we need to focus on the fact that with the new administration, we're probably going to get some stability. And in the ultra high net worth market, stay the course. Keep doing your planning and take advantage of the increase in the exemptions as they come out. I think for everyone, though, I don't care, everyone, we need to focus in on flexible planning techniques. I think that's the name of the game. I think it always has been, and stick with the basics. Make sure that when you put an estate plan together, make certain that it matches your legacy vision.
I mean,
Yeah.
that's definitely a conversation we have often, right? What I always say to clients is like, we need to understand what your goals are, what your values are, what your dreams are, because we can put together any type of plan. But if it doesn't match up to who you are, what you want to have happen, how you feel about your family, charity, or whatever, there's no point in going through that process.
I would totally agree. You're preaching the choir on that one. Yep.
Okay, so I think we've talked kind of a lot about the tax job and say that 3 times fast, the
I
Tax
know.
Cut and Jobs Act. And hopefully, everyone on tonight got a better understanding of what's in it. We really simplified it, right? Because I'm sure it's 100-some-page bill, like everything else that goes through. But we broke it down into those really 3 main areas, which are what affect our clients, right?
Yeah.
Taxes, income taxes, business owner deductions, and estate planning with the exemption. Those are conversations that most clients are understand and want to have a conversation on. Right? So let's kind of take a different perspective, just Amy, from your experience, right, as an estate planning attorney, kind of what you see. Are there any with what we think we're going to get some stability, right? And with these current rules, is there any techniques or any type of guidance that you think is kind of like something that people should be considering?
Mhm. So people in the ultra high net worth market do a lot of trust work. I mean, if you have a certain, asset value, you know what trusts are. Attorneys and CPAs, financial professionals are talking to you about these all the time. And a lot of these trusts are irrevocable. I think that clients need to bear in mind a couple of thoughts. First off, that trust is not irrevocable until it's executed, until it's signed. So work with Michelle, talk to, the family, figure out what your vision is and hardwire that vision into that document. That's your prerogative. You should be able to dictate what's happening in that document before it's executed. Now, the second thing is flexibility. There are so many things that we can do to add flexibility to an irrevocable trust, but we don't talk about it enough. The one I like the most is a trust protector. So a trust protector it's similar to a fiduciary in that they're not a trustee necessarily. What they are is a third party that your client would name to step in the event of certain trigger points, trigger events, even, you know what I mean? I had tripped up on that. It's late. I may need coffee at this point. No, um, but this person, this third party, is somebody who can do amazing things. They can change the beneficiaries if that's what needs to happen. They can terminate the trust. They can shut things down. They can rewrite things if legislation changes. Use your trust protectors. They're amazing. Also, other powers that you can give your beneficiary to move assets out of the trust to certain pools of individuals, to charities, those work really well too. The key here, when you're working with your estate planning attorney, ask them, okay, what sort of flexibility can we add to this irrevocable trust? And work through that with them.
That's a great point because I think a lot of people are, or clients are a little hesitant making some of those decisions because it's the word irrevocable that goes with it. It's kind of like, all right, I make this decision today. I don't know what the future holds and things could change, but now I can't change that decision. So what you're saying is if the attorney puts in certain flexibilities, you can really blow the whole thing up if they needed to. Change the entire thing if the tax laws change to do that. Is that kind of what you're?
Exactly. Yes. I think too, clients believe that the attorneys know best and they just follow the attorney's lead. Whatever the attorney says, let's do that. And I think that's a terrible approach. You need to go in knowing exactly what you want and make certain that you're partnering with that attorney and the document reads the way you want it to read. Yeah.
Coming from an attorney.
Yeah. Coming. Hey, I used to draft these things.
Right.
Yeah,
That's why you can make that statement. Yeah.
that's right.
But I think that's a great piece of advice. And that's definitely something that all clients should be aware of. And I know that I will add that into, my practice when speaking with clients and helping them educate so that they can understand what these decisions do, but the flexibility we can build into it.
Exactly. I tell my clients, you're the master of the plan. Yeah.
Absolutely. Okay, so thanks for sharing that. And we learned a new term tonight. I wasn't aware of the term trust protector. Um, Anything else that you think would be important to share tonight on this topic?
If we go back to the politics of this subject, we're talking about this idea that we believe we're going to get some stability. Part of that stability is coming from the fact that for the next 4 years, we do not expect to have an influence that is going to drastically change things. In my business, we call it the Elizabeth Warren effect, where we have some proposals where we're taxing people simply because they have wealth. And we don't expect that we're going to see that over the next 4 years. Whether that's good or bad from a moral perspective, we're not going to get into that. what's important with that idea is that that too lends itself to stability in our business for tax purpose or for tax rules.
Yes.
Yeah,
Just say we can, as long as we know the rules of the game, right? We can develop a plan.
exactly. Yes. Yes. And I think it's also worth noting that in both the House and the Senate, Trump has, Republican control. And, Senate, we've got 53 Republicans now. We've got 47 Democrats. JD Vance is going to have the tiebreaker for a vote, or the vote for a tiebreaker. In the House, that one's close. We've got 218 reps, Republicans, 212 Democrats. So Republicans are in a solid position to affect change and to continue TCJA's provisions from the former Trump administration.
Right. Would you say that's probably one of their top priorities in the first term, the first year of the term?
Because we have this looming deadline, it almost has to be, because to allow these things to expire, that will be jostling for the industry. Because if it expires and then they get in there and negotiate and make changes again, that reflect TCJA, that will be very, very difficult. But at the same time, I hesitate though, because Trump's made me a liar before. And it could, maybe he won't focus on this, maybe he will, I don't know.
Right. It's just kind of what we believe to be true based off what the chatter is and kind of what the setup is. Right. No one has
Yeah,
the crystal ball.
exactly. Yes. But again, he's got a deadline, so hopefully he'll meet that deadline.
Right. Right. All right. Well, we are coming up on the end of the hour here. We, covered a lot of different topics, and a lot of that stuff can go deep when we're talking about legislation and tax laws and everything. But I think maybe we'll call it for this evening for our November webinar. We have one more left next month for December. That will be the last of the year. So for those of us that can join, that would be great. And then it will be time for 2025, and we'll be talking about the TCJA again, because then it will be on 2025. So thank you everyone tonight for attending. Thank you, Amy, for your expertise. Jay, thank you as well. And we will see everyone next month. Take care.
Thank you. Bye now.